Hi guys, thanks for tuning in to another episode of Nuggets News. Well, it's been a little while since my last crypto update, so today we're going to talk about the crypto markets and probably more importantly the macro backdrop, how that's going to affect the crypto markets, and a bit of forecast on what I see happening next. So I think the big story is all about inflation at the moment. I did a write up for our members back in May, and I'm going to let you guys have a read of this. So feel free to pause and read through this now if you're not a member. But I spoke a lot about how everyone all of a sudden is very fearful of inflation, and in other posts, how people have been positioning themselves accordingly. And we're certainly seeing that play out at the moment. When we last did a Bitcoin update, Bitcoin was a bit under 30,000. I think Ethereum was still around $2,000, and we spoke about how on some of those higher time frames there was a bit of capitulation. We might see a little bit of relief, or at least the bleeding stop for a couple of weeks, but it was probably another low coming. And you know how things played out. ETH got all the way down to 800, 700 on some exchanges. Bitcoin wicked down to $17,000, and that to me really felt like, and I did post for members at the time about why I thought that was a high chance to be the bottom. So we've had a bit of a bounce since then. We'll talk about all that in a second, but I think one of the other things I wanted to highlight was how the fear of inflation and the fact that we can continue to get these high prints, but the bond market was the big clue for us about looking forward to what markets are expecting to happen next. And one of the things that I predicted was, even though we might get continued high inflation prints, and in June we got the highest one we've got so far, 9.1%, but if we actually have a look at the stock market, it actually rallied, and that was, I guess, a little bit contrary to what everyone was thinking at the time, that there's no way that we can have a rally in stock markets or crypto markets if we continue to get this high inflation. And I guess I went against the grain a little bit there, and we'll talk about tying all that together and what happens next. So if we have a look at the stock market, we can see that generally since we've had this downtrend, it's been as inflation and CPI has been rising, but I think with the actions the Fed are going to have to take next, a little bit of sideways, but I think a lot of the worst of it is behind us now, particularly the fear of inflation. And I think the thing that we need to be more mindful now of is the chance of a recession and the headlines around the recession and the fear that comes with that. More importantly, what central banks are going to do to react. So this is the weekly chart of Bitcoin. We've had that bit of a bounce, and this is the last time we did the video, during this week in capitulation, and all we got was that bit of sideways chop, and the bleeding stopped for a bit, but there was no strength, which probably was that signal that there's another leg down coming, and then we got that capitulation below the 200-week moving average. We're below the Bollinger Bands again, expecting some relief, and all we've got now is a rally back and rejection from, so far, the 200-week moving average. Now, one of the things I spoke about was that I actually expect ETH to be stronger and for ETH to possibly even lead the next cycle. And ETH's shown a lot more strength than Bitcoin recently. So as I said, on some exchanges, wicks down to 800, 700. And I posted in the group at the time that I don't think you get another chance to buy ETH, below $1,000, particularly that capitulation week pricing. So if ETH can actually hold that in the coming days or weeks and get a bounce, we'll talk about these other ingredients that are also currently in play to give us a bit more conviction that that was in fact the bottom. And there's a lot of people on the sidelines. There's a lot of sentiment out there that says, we can't have a rally or strength while there's such high inflation, while there's rising rates from central bankers as they react to those numbers, and particularly while there's a recession or fears of a recession. And often when everyone is positioning themselves or already fearful of that, particularly given the capitulation we had, I think that the worst is probably already behind us or priced in. Now, we saw a record amount of stable coins on the sidelines. A little bit of that has been deployed. if you look at the overall stablecoin numbers, but there's still a lot of people on the sidelines, and we're actually seeing very similar things in the stock market at the moment. So this is a really important week for macro and for crypto. We've got some earnings from some of the biggest companies in the world this week, that US Q2 GDP report, and the Fed will announce what they've done with rates after we've seen Australia go pretty aggressive, Europe go pretty aggressive. What will the Fed do? Are they going to be just as aggressive? But I think, interestingly enough, we've already seen some of this jawboning about, well, even if it's a second consecutive negative GDP growth, that actually doesn't mean it's a recession. And, they keep chopping and changing the definitions, and it's so funny that a lot of the time before these numbers have come out, we've had a lot of stuff in the media from the talking heads almost gearing the market up in anticipation of, inflation's going to be higher, even higher than we expected. And now, a few days before this number's expected, they're coming out and saying, oh, look, even if it is a second quarter, this isn't a real recession, or we're going to change the definition slightly. So all the usual stuff, smoke and mirrors. I guess the problem with the mainstream media and establishment as a whole is just that it's all just, don't look over here, look over here. This is what we want you to believe. Changing the definitions of things. It's crazy to watch this play out in real time. Bank of America survey shows full investor capitulation and pessimism. You guys know how much weight I put in sentiment over the years, and if we look at these charts in terms of how overweight investors are in equities, we're now at these lows, record lows, even lower than back in the GFC 2008, 2009. But again, that sentiment of such an extreme can tell us that the bottom's probably closer than a lot of investors are fearing, and how they've already positioned themselves because of what they think's coming. And I actually think that what is coming is very different to what investors are positioning themselves for in the stock market and the crypto market. So risk appetite, a couple of more charts here. Once again, not taking risks, and the cash levels. A lot of these fund managers that get surveyed here, these cash levels are back as high as 9/11, so over 20 years ago. There's a lot of cash on the sidelines in traditional market. There's a lot of stable coins on the sideline in the crypto market. That can all get injected back into those markets once people believe the bottom is in, or the worst is behind us, or the point that I'm getting to with all this, the fact that I think that rate cuts are coming and more money than ever is going to be printed. The only way out of this mess that they've created is to continually perpetuate it. So similar story across Europe. The German economy is usually the strongest, the powerhouse, manufacturing, and we see here a lot of that business sentiment. This is the same across Australia and a lot of developed countries where it's just really negative, and these are so closely correlated that I do think we're going to turn down and go into a recession, even if they want to change that definition. So look, at the moment, the US dollar index has been outperforming and very strong. They've raised interest rates more aggressively than Europe and places like Japan, with the yen getting smashed because they've still been at or near zero, and only just in the past month maybe started to tick up their rates. So the world reserve currency, it's still the cleanest dirty shirt in the laundry. People want to park there. They can get some interest rate on it that's better than a lot of these other countries. Now, big picture, I'll probably do a video at some point about how the place we're heading is to things we've spoken about time and time over the years, commodity-backed currencies, this illusion of people just giving goods and services and commodities to each other for money that's printed out of thin air, and the privilege that comes with having, whether it's the US dollar or these other global basket that go into the special drawing rights. And we're just seeing the likes of all these different countries that actually produce things actually having way more power than previously, because of how globalization has changed those supply chains and all those things that we'll get into it at another stage. But yeah, the Europe hitting 20-year lows, hitting that parity mark with the US dollar, as they're late to, like a lot of countries, late to raising rates to try and get ahead of inflation. So this is the US government bond, the smart money that we talk about. the rate on the US 10-year bond, and it's been in this declining channel as we've had decreasing rates since the 80s, and it has peeped its head just above here once before and gone sharply back in. So yeah, we've broken out. We haven't made a new high. It's never made a new high during this downtrending channel or price movement. But I think at some stage we roll over pretty sharply. So yeah, inflation, some of these CPIs are 8-9%, but I just think there's no way on earth that we're going to see interest rates that high. Maybe mortgage rates and that creep up for 6 months. The banks want to protect themselves, and that's going to hurt the economy. But I don't think it's anything that's going to be sustained. I think these sharp increases, because of the fragility of the economy, even if we get a couple more, they're going to have to roll over so sharply. And if you just look at this trend, it's like we saw in Europe. It's crazy to think that we could be talking about negative rates in somewhere like the US, but still comparatively to what others are going to have to do. And if they don't hit that interest rate lever, it's the only other lever they really have is the QE and the pumping money into the banks. Or for the first time ever, we saw direct pumping into consumers' accounts, average citizens, and bypassing that system of the bank lending theory. And they're probably going to be fearful of that and say, oh, look, that worked, but look at the inflation it caused. So yeah, I do see a scenario where we can have a recession, but we can actually have stock markets rising, crypto markets booming, because the only way out of this is to perpetuate the debt. And a lot of you remember, it seems like only yesterday when this was at 20 trillion, a few years ago when we were doing videos, and all of a sudden we've crept above 30 trillion. A lot of other countries are trying to print their way out to make up for the difference of not being able to afford these commodities and people they're doing trade with. But it all comes back to the poor running and management of the economy, none more so than Australia, resource-rich economy. But we're still paying record prices for gas, petrol at the Bowser, food and all that, where really we should be doing more, productivity and protection of resources and looking after things in our own backyard, manufacturing, because, yeah, you might get those slightly lower prices, but I think the world has really been shocked into saying, well, we can't rely on these other people with the geopolitical environment, sanctions, and whatnot. So this is US M2 money supply over the past 25 years. And any time we've had a slowdown or a downtick, it just puts us into recession. And that's how crazy things have gotten lately, just as you stop expanding the debt just ever so slightly, only going sideways, barely even ticking down. And this is going to have to sharply increase, from 2020 there, whatever it was, 15 trillion up to 22. In a year or two's time, we can be looking at $25-30 trillion with the QE and everything I've just spoken about as the only way to perpetuate this and keep it going. So a lot of you will remember we did this 4-part series. I might do another part in future. For many years, we've been talking about how Bitcoin is going to eventually reach $1 million. We're speculating about it. One of the stepping stones on the way there being hitting the $1 trillion market cap and surpassing a lot of these large cap companies. That has certainly played out now. So whatever happens in the short term, it all just really is noise on the, I believe, a low probability chance that we make new lows. I still think it's a gift in the grand scheme of things. If ETH makes new lows as well, you'd be talking $600, $500. I still think we're on track to $10,000 in the next cycle, so a gift. I'll continue to share ideas in the group about different projects, the sectors I'm most bullish on. I've already shared those. I've shared a few hidden gems, other macro updates. So as always, guys, make sure you're subscribed. If you want more video updates, I'll be trying to do them more regularly, and if you want those regular updates and to join the new premium group, there's a link down below. I'll send you a message. Make sure you check your message requests and your spam as well. We've had a few, 100 people or so on top of the 240 odd that are already in apply, and a few of those people appear not to be seeing those messages, so they might go into your message requests or spam if you are keen on joining. So Thanks for tuning in, guys. Hit that like button, subscribe if you haven't already, share these videos around, and I'll talk to you again soon. Cheers.